Hey, welcome everybody. I am thrilled today to be joined by Andrew Craig, who is the founder of Plain English Finance and the author of several books, one of which is my new favorite book, How to Own the World, which, thanks to Andrew's book, I now own the
and
world.
not in a sort of dictator sort of owning the world kind of way. It's just about investment, and it's not and nothing more fair.
Well, I think today it's actually very prominent that we're talking today, given that today is election day in the UK. It's
Yeah.
a shame we didn't have this scheduled for yesterday. We could have swayed the votes by sharing with the general public some of the catastrophic decisions made by the UK government, like selling our gold reserves, Labour Party, and many other things.
All-time low. Yeah, we can definitely come on to that. Gillespie and Brown thinking he's got a reputation for fiscal prudence when he demonstrated perhaps the highest level of incompetence of any chancellor in the history of Britain. So yeah, but anyway, and to be clear, I have no party political axe to grind at all. And I know you probably don't want to launch straight off into politics. My view, I mean, today's really tricky for me because there is no electoral party in Britain that represents my view. It just doesn't exist anymore. So it's a bit tricky to know what to do. But anyway, let's move swiftly past that.
let's
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 talk about
let's
politics.
yeah, let's help our listeners know actually what they're here to listen to, which is not a party political broadcast, but it is about teaching people how to make their money work for them and how to take charge of their financial future. And one of the reasons that I reached out to you, Andrew, after being glued to your book for hours and hours and hours on end, which I never thought I would say about any kind of financial
Thank you very much.
investment
I always
book.
get being British. I always get really bashful when I hear stuff like that. But after 10 years after publishing it, it doesn't get old. It's really lovely to hear when people enjoy the book and get a lot out of it. So thank you.
It takes a lot for me to be impressed. You only need to talk to my ex-boyfriends to find that out. And your book had left me so animated that I couldn't not have this conversation with you because I felt so many emotions and so passionate about why do people not have this knowledge and insight to take charge of their financial future. So I think we're both on a mission to have an impact on the lives of people. We're maybe just following slightly different pathways. So
Only,
I'd
only,
love.
only slightly different though, because mental well-being and financial well-being are so inextricably linked, for sure. So, which is why, again, why I'm delighted to be on this call, and sincere thanks for inviting me on.
My pleasure, my pleasure. Let's just make sure that your fund that I've now invested in makes me a multimillionaire, because
Well,
otherwise I
we'll
know
have to
where
come
you
on to
live.
that. We'll come on to the specific because it's important to use a mix of funds in an age-appropriate way, and we can come on to how best to do that. So our fund is a very defensive fund, and we should probably take this offline. But we need to make sure you've got some aggressive stuff as well. That's I'm about to, as we were saying before you click record, I'm just about to publish the new updated version of my second book, which is called Live on Less, Invest the Rest, which, if you like, is so my first book, How to Own the World, is the theory, and lots of economic history and the sort of commentary around, isn't it crazy that nobody learns anything about finance, really big picture stuff. And this book is much more the nuts and bolts for a UK national. Crucially, I think that's part of why the book's been quite successful, is that, and actually you see a lot of comments on Amazon about this, is that most investing books are catering to Americans. So a lot of people buy books online and it's all about America, and there's no commentary around British accounts like ISAs or pensions or whatever else. But this is it's taken me 4.5 years to get this updated version done. But that very much goes into the sort of weeds and the nuts and bolts of how do you use an ISA, how do you use a pension, how do you use the right mix of funds, how do you think about that, doing that in an age appropriate way. So yeah, you and I should talk about that because my fund's a defensive fund, and you probably need a bit more spice in your portfolio, so we can talk about that.
Um, So, yeah, I think it would be wonderful to talk about both of your books, but certainly the one that blew me away was How to Own the World. And as I say, I felt incredibly passionate that people really needed to know this information. And I don't think I've ever had so many conversations about finance with people as a result of reading a book.
Well,
And what
sincere apologies to all your friends and loved ones for subjecting them to that in the last few weeks since you read it.
No, it's been wonderful. In fact, my dad and I had a full-on conversation about something that didn't involve golf.
Oh,
We
brilliant.
started to talk about funds. We were talking about inflation. I was like, compound interest, all the things that I'm going to talk to you today about. But we had the most insightful conversation. But it really struck me that there were some of my friends that had an investment strategy, but more often than not, most of them didn't. And a kind of, similar ages to myself, mid 40s. And I thought, why are we talk about so many things in our friendship groups? We might talk about houses, we might talk about the cost of living, but nobody talks. Maybe they do in your circle of friends, but to me, I'm like, why are we not talking about this stuff? So I'd love you to just say a few words about what inspired you to write these two particular books, Andrew.
Well, I suppose I always sort of joke about the fact that basically I was an angry young man. You know, I was working in. I was very lucky. I did an economics degree. Started in the city as a sort of, as my grandmother used to describe me, as a rogue trader. You know, in the late '90s, and I started with what was then SBC Warburg, so basically Swiss Bank, which is a pretty fantastic place to go to work for straight after university. And what really happened was, so I was a plain vanilla stockbroker. So my job was to call people up and say, EasyJet are raising hundreds of millions of pounds to buy a bunch of 737s. You know, do you want to invest in those shares and give me 10 million quid and we'll give it to EasyJet and off we go. And that's basically the job of a stockbroker, is to call up people with large pots of money and say, you know, we think you should be buying Burberry or EasyJet or Marks and Spencers, and we think you should be selling. Oh, well, I'm not going to mention any names for sales because I might trigger a compliance concern, although it's many years ago. And it was an amazing job. You know, it was a super exciting job. It was such an honour to do it because I basically got to travel around. Well, in my career, I've probably met certainly more than 1,000. It might be as many as 1,500 chief executives of listed companies now from all over Europe, predominantly because I did the UK and the rest of Europe. And what was amazing about that experience was that, and I was saying to you before you hit record, is that even highly paid city professionals were completely hopeless at their own personal finances. So you get these sort of masters of the universe, investment bankers, captains of industry, who, if you said to them, what are you doing with your pension or your ISA, or as it was back then, what was called a PEP, which was the precursor to an ISA, and they'd kind of look at you blankly and go, oh, I don't really think about that. I've got a financial advisor. Oh, my pension's only been doing 2% a year, you know. And you think, well, that's just crazy. And so that's the angry young man bit. I thought, well, you know, if these people who are steeped in capital markets and allegedly super financially literate and are being highly paid and have the best chance of anyone to make the most of that with investment and become seriously, you know, wealthy, but they don't, and a lot of them don't, right? Because a lot of them have huge lifestyle creep and spend lots of money. It's the same with professional sports people. It's the same with movie stars and rock stars. You know, one of the other wonderful, there's some stat that something like 150 ex-professional footballers in the UK are in prison because although they made 30 or 40 or 50,000 pounds a week for the, you know, but loads of their early 20s, they never learned about investment. You know, they put money into dreadful property investments in Dubai through their mate Dave or whatever. And it's a really well known. The Premier League actually have a sort of internal project around this, is sort of young player education to not lose all the money they get paid, because there's a horrendous stat around just how many professional sports people are bankrupt within a few years of leaving sports, which is why so many of them are in prison, because then they turn to crime to try and sustain these lifestyles and the cars and the whatever else. So the other stat, while I'm on that, is the US National Endowment for Financial Education cites the fact that 70% of lottery winners are bankrupt within 5 years of winning the lottery in America, right? And these are tens of millions, sometimes hundreds of millions of dollars. So the insight there is, wealth is so much more about habit, knowledge, and et cetera, than high incomes, because lots of people on high incomes could become bankrupt. There are, the examples of celebrities: Michael Barrymore, Carrie Katona, all of the members of the band Blue, if you remember them from back in the day.
No, I don't. I must be too young.
No, it's definitely our era. It is. But anyway, George Best and his son Callum Best. These are all people who went bankrupt. So these are all people who had very high incomes who never learned the nuts and bolts of finance. Then you've got all these people in the city on very high incomes who've never learned the nuts and bolts of finance. And then you come back to a stat, an eye-watering stat, which is that more than 90% of British adults don't have a stocks and shares ISA. So more than 90% of British adults are not knowingly or proactively investing in the stock market because they don't know anything about it. 60% of British adults don't know what compounding is. And compounding is what turns hundreds of pounds into millions of pounds, literally, as crazy as it's just the inevitable mathematics. And I show all these tables and stats in the book. But if you can invest a couple of £100 only, even a month for many, many years, and return the sort of returns that stock markets generate over very long periods of time, you should get to a high six or even low seven-figure sum, right? And so the biggest problem is one of financial illiteracy. And then the final corollary to that, which made me want to write the book, is, so that's obviously terrible for individuals. And I've just given loads of examples of, sports people and celebrities and indeed, the man or woman in the street who's not making the best of their finances and is really struggling financially. But what's even more important than that, and it's writ large today, with today being election day, is it's really, really bad for our society. Because, being financially challenged causes divorce, causes stress between loved ones. Being financially challenged is terrible for children who are dependents. It's, it's related to mental health, it's related to health, everything else. And to me, the way I describe financial literacy is, without exaggeration, a silver bullet for massively improved outcomes for individuals. Tens of millions of people sort this out. Tens of millions of people will have a better life, and by extension for society as a whole. And one of the reasons that Britain is in the predicament it's in, and the reason I can't vote for anyone today, is because we've spent the last 30 plus years eviscerating our investment culture. And the reason Britain became disproportionately wealthy and such a lovely civilized country with great architecture and sports teams and all the wonderful fruits of modernity that we have as a nation state, partly because we had an empire and we took more than our fair share militaristically, which we could perhaps come back to. That's definitely played a role. But that was the reason we accrued a disproportionate amount of capital, as any empire does. But one of the underpinning realities of why Britain became a really wealthy country is because we basically, along with the Dutch, we invented financial markets, we invented the stock market, and we were disproportionately good at capital markets and financial markets for 2 centuries. And in the last 30 or 40 years, we've been slowly dismantling that. And it really pains me that the majority of people can't draw the link between those two things, right? The fact that the reason we have a cost of living crisis is absolutely inextricably linked to this point, is because we are very, very poor at investing. The government has to therefore invent money out of thin air because we don't deploy capital to create wealth anymore, anything like we used to. And that is, when you invent money out of thin air as a government, you create inflation, right? And that's what's happened. And if I may just finish off, sorry, I give very long answers, so sorry about that. You can shut me up at any point, but compare our experience to Singapore. So the average British, in US dollars, to compare apples with apples, British incomes for full year 2022, $46,000 a head. This is about £30,000 thereabouts, right? Singapore's is $86,000. We're $46,000 and going backwards, and we've been going backwards for many years, which, by the way, should never have happened under a Conservative government, for what it's worth. And Singapore's are $86,000 and going upwards. In Singapore, employees are mandated to commit 20% of their income by law into pension investment, and then their employers match that to the tune of 17%. And they've been doing that for the last few decades, and the net result is that the Singaporean investment fund Temasek has $400 billion, and most people in Singapore are very wealthy. And Singapore, Singapore's a bit hot and humid, but in a per capita wealth basis, it's a fabulous place, and it's had an amazing trajectory in the last 30 or 40 years. 30 or 40 years, we've gone completely opposite direction. And so there you go, very long answer, but basically I wanted to write the book because financial literacy and getting your finances right is absolutely front and center, one of the most important vectors for having an easier, less stressful, more abundant life, being able to take care of your loved ones, etc., etc. And we just teach it so badly that too few people are doing that. And that's terrible for tens of millions of people, but it's also terrible by extension for the society we live in. So I wanted to write a book to summarize all of that and try and in my own small way change it.
Well, I'm glad that you did write a book,
Thank you.
because even though that book came to me, I'm 46, and I thought, gosh, what difference this would have made to me if I had read your book
For
10
20,
years ago. I don't think it was published 20 years ago, was it?
no, it was published nearly, well, wait, September 2012. It first came out as an ebook, amazingly enough, on Amazon. So yeah, it's 12 years ago now.
So if I'd, and this is where I felt such mixed emotions reading your book. It was like being on this emotional roller coaster of like feeling so empowered that I was going around buying gold and setting up ISAs and investing in your fund and owning the world, but also real trying not to feel a sense of regret
Yeah,
it having not known about this and not taken the time to know about it. And we'll come on to this in a moment about people's relationship with money and the psychology around what's getting in the way of people taking action, but also a real sense of anger that, having had financial advisors for the last 10 years, neither of them have ever spoken to me about anything that was covered in your book. If they'd said, one of them I had 10, 12 years ago, if they'd said, Sarah, set up an ISA, and this is the kind of ISA that you need to set up,
yeah,
because
yeah.
obviously there are a few, and stick even just £100 a month, £100 a month into that ISA, this is the effect that it'll have. I thought an ISA was a savings account. I
Yeah, well,
didn't even know it was an investment account.
that's right. That's why more than 90% of British adults don't have them. And a hair-raising story for you. Because I self-published my book initially 12 years ago, and now it's published by Hodder, like one of the world's biggest publishers, along with Penguin, which is obviously lovely. And one of the best phone calls I ever got in my life was when it was 5 years ago or whatever, and I got a call from somebody saying, "Would you like us to publish your self-published book?" And yes, please, was the answer. But when I was doing the self-published version, I found a professional editing company to give it to a professional editor to sort of give me notes and feedback before we put it up in lights on Amazon. And I was introduced to an individual who was probably in their early 60s and had a career as a financial journalist for 30 years and had written for really big papers and on paper looked fantastic. And they read the book and came back to me and said, "Oh, in your book here, you're talking about making returns of as much as 10% or even more than that in an ISA. That's impossible. I'm looking at my newspaper right now, and the best returns on cash ISAs are 3% or whatever interest rates were in 2012. And it was clear that this individual who'd been a financial journalist for 30 years, even they didn't understand the absolutely crucial difference between a cash ISA and a stocks and shares ISA. So, and it just became, what was the point of having this person edit my book? Because they didn't have the knowledge they needed. But, again, there's a financial journalist who didn't know something as important as that, the difference between a cash ISA and a stocks and shares ISA. And if they don't, what chance do most people have? But can I just say, because I think it's one thing that's really important, because you get a fair measure of cynicism, quite rightly, from people when you start to, oh, it's really easy, you can become a millionaire, just learn about investment. But let's just put some flesh on the bones, because one of the most important things people understand is the sheer power of compound interest. And surveys say that 60% of British adults don't understand compound interest. And I think that if there's one thing the government should do next week, they should sort that out. We should have a PR company to show people mathematically what happens.
You've got it. I mean, I've been selling your book in New York to, in fact, I even sold your book to a New York stock exchange trader.
Well, that's very good.
I'm your new PR company, Andrew.
Well, yeah, well, I certainly need a bit more PR. Well, sadly, we can't afford it at the moment. We've had a bit in the past, but you know, so I use this example. If somebody's lucky enough that a great aunt Agatha or grandparents can put £5,000 in a tax-free account, which is an ISA account, on the day a child is born. If that £5,000 with no further investment whatsoever, just one £5,000 dunk, £5,000 the day a child is born, if that returns 10% per annum, and let's just come on to that in a sec, 10% nonsense interest rates are 4% or whatever they are right now, and they were 1% 3 years ago, yeah. But if that returns 10% per annum, obviously after year one you have £5,500, after year two you have £6,050, I think I'm right in saying, and so on and so forth. How much will they have on their 55th birthday, which is the first year at the moment you can legally retire? And the answer is £945,000, right? And so that's the sort of first, this is the power of compound interest. Or put another way, if a 25-year-old spends £1,000 on a TV at the age of 25, but instead they put it in an investment account, a tax-free investment account, and they made market returns of just north of 10%, when they were 65, they'd have £63,000, right? So £1,000 spent by a 25-year-old could potentially rob their future self 40 years later of 63 times that sum. So think about that in terms, if they managed to put £10,000 in at 25, they'd have £630,000. And so the big pushback you get is, so A, people don't understand compounding, like mathematically. Like we're very bad at teaching maths in the UK. I'm a good example of that myself. I was never particularly good at maths. I only really got into percentage changes, when I started my career. I sort of try to avoid maths as much as possible, notwithstanding doing an economics degree. But I'm not claiming to be a brilliant mathematician. But these are, there are websites you can go to look at how compounding works. And so most people don't understand that. It's really important to understand that. So then the next pushback is, okay, well, what a nonsense. How can you possibly make 10% on your investments? That's just rubbish. And then the counter argument to that is, okay, but the American shares from January 1923 to December 2022.
I was going to say.
Yeah, they got in a time machine and went backwards. Over 100 years, the average return on the S&P 500, the 500 biggest shares in America, is 10.42%. Now, along the way, there's volatility and there are stock market crashes, and the way you mitigate that is by investing for very long periods of time, investing every month without fail, closing your eyes, sticking your fingers in your ears, and ignoring the news. Because that's another thing people don't understand, is that the news and the if you like, Main Street and Wall Street are hardly correlated. So if you'd said to the average person at the height of the COVID crisis in early 2020 or April 2020, let's say, do you think it would be a good idea to invest in the stock market right now, right? What do you think the average person's answer would be? Well, you've got to be kidding. Crisis, global pandemic, NHS overwhelmed, people dying in the streets. No, of course not. Well, in the following 3 years, equities had the best 3 years they'd had in years. They were 1 year up 20%, 1 year up 30%, whatever the stats were. So this is another big thing people don't understand is amateur investors watch the news, see something happening in Yemen or Gaza or Ukraine and go, oh, the world's this terrible, febrile, dangerous, scary place. I shouldn't invest in the stock market. It's too dangerous. Which is absolutely 180 degrees the wrong thing to do based on the evidence of 2 centuries of history. And so if you can invest regularly each month for very long periods of time in the market, the stock market, it doesn't have to be the US stock market, and we can perhaps come on to that. You can buy the world stock market very easily and inexpensively now. You can own 4,000 companies with as little as £25 a month in a world stock market index. But if you do that every month, ignore the news, ignore the nonsense, ignore talking heads, and just do it every month from the time you first start earning money to the time that you want to be able to live on your money, which is the ultimate goal of investment. That's what a pension is. you've got a really good chance of trending towards 10% annualized returns. You mustn't panic and sell out in crashes. You must just carry on doing it. And so that 10%, using a sort of 10-ish percent, maybe use 8%, use 9%, you have to account for inflation. So US shares have returned 10% for a century. Real returns after inflation has been about 7.25%. But those returns are enough to absolutely change your life. And the tragedy is most people don't understand it, most people don't believe it, and most people aren't conversant with these things, which is why I've written about it. And then the other point to make is it's really important to understand to use the right mix of assets, which is the whole how to own the world. Why the book's called How to Own the, because it's not, you need to basically own America, Asia, and Europe, because you don't know where's the next hot area going to be. America's been amazing for the last 10 years. Japan's just become really good again, but was rubbish for the previous 20 years. But if you just own a mix of all of them, and then also in 2008, the stock market halved, but oil hit an all-time high. And in 2009, gold was up 20% in US dollars. So you need to mix your assets and you need to mix your geographies. But all of this stuff,
Can I just pause
really
you for a
understandable.
second?
Yeah, of course, yeah.
So I'm kind of just thinking that at this point, some people's minds might be just getting really boggled. And this is where we know people
Switch off.
Well, I was going to say that if people don't understand something, or they feel a sense of fear or overwhelm at thinking, well, he's telling me I need to invest. I don't even know. So a really simple question. What's the difference for anybody listening? What's the difference between investing and trading?
Well, I've done a video about that on my YouTube channel and written about it. I've written reams on that. That is a fantastic question, and it's really, really important thing to understand. And actually, anybody under the age of 40 nowadays, sadly, for all sorts of reasons, demonstrably doesn't understand the very important difference between investing and trading. So investing is something you do every month without fail. It's a really boring life habit alongside any other boring life habit you do every month, like going to the gym or shopping or whatever. It should be seen as a really...
That's not boring.
I should have said grocery shopping or going to B&Q. I'm not talking about beautiful boutiques in Mayfair or whatever. But basically something you do every month without fail. You get it set. You have a basic understanding of what to do, and you just do it as a habit. And investing builds wealth slowly, surely, gradually, inexorably over many, many years, right? And you don't actually. So I've also done a video and a piece called "Money is a Long Form Thing," where one of the arguments I make is, okay, you don't need a PhD to get good at money. Although the analogy I usually use is learning how to drive your finances is no harder than learning how to drive a car. So it's crazy societally that we're all like, it's very normal for a teenager to get their driving license and go to the pub and everyone they've got their driving license. That's very normal in British society, and nobody kind of questions the endeavor required to become a driver. How long does it take to learn how to drive? A few tens of hours, maybe 100 hours. I don't know. It depends whether you're naturally gifted at it or whatever. But whatever it is, it's that amount of time that you commit to learning how to drive, committed to learning how to drive your finances. What is an ISA? What is a pension? What are shares? Will allow you to basically do what I'm talking about, which is to invest safely and get a fantastic result for your life. It's just a crazy societal blind spot that everybody thinks it's normal how to learn to drive a car, but if you exert the same amount of effort to learn how to drive your finances, everyone goes, well, that's weird. That's for rich people. And by the way, that's really important to make as well, is investing in capital markets, financial markets are not for rich people. The reason there's a correlation between rich people and capital markets and understanding capital markets is because if you understand capital markets, you're much more likely to be rich. So correlation and causality run the opposite way to what most people think, oh, stock markets are rich people. No. You're much more likely to be rich if you understand about stock markets, and that's kind of what every single wealthy person in history has understood, right? But to come back to, can you remind me of the question? And then I will answer it really quickly.
Yeah, so we were talking about, so one of the
investing
things
versus
that,
trading.
I took from your book is because as I was going through and I was learning about asset allocation and how important that was, and I did remember feeling a little bit overwhelmed because I was thinking, oh, I'm going to have to monitor the stock exchange. And what I realized is I went on to Interactive Investor's website. Interactive Investor are one of our corporate clients. We'd trained them in mental health management. And I saw that they had a managed ISA that basically I've now got a direct debit set up. So they are the ones that are doing the legwork, the heavy lifting, and I sit back and reap the rewards. And I also, and I'm not saying I've got any commission or affiliate link with you, but I chose to invest in your fund because that enabled me to invest in all of the commodities and the bonds. And it was so much simpler because I genuinely thought I'm gonna have to be like on Yahoo Finance every 5 minutes if I'm gonna make this work.
But that's really important. So yeah, sorry, I forgot. I did my usual thing of going completely down a rabbit hole and shouting at the screen, and
The difference between investing and trading.
which is really important. Trading is what too many people think investing in is, which is, you buy some shares on a Tuesday and they go up a bit and you sell them on a Friday, or or the crypto. This is it makes me so angry that a generation of Brits have basically bypassed the stuff that's been around for 2 centuries and works, which is the stock market, the bond market, gold, and invested in fabulous tax shelter. All an ISA is, or a pension, is a tax sheltered account that the government gives us lots and lots of headroom to do the best we can with our finances in account. An ISA is not an investment. A pension is not an investment. It's just an account that you put investments in. So you need to understand what an ISA and a pension is, and you need to understand what the basic biggest categories of investment are, and they are shares, bonds, commodities, and property, and cash. And once you understand those things and how to get a bit of those and what the right mix is based roughly on your age, and it's really important. Occam's razor, the simplest answer is probably the right answer. Like you should do, if you do, investment success to me is 90% admin and 10% asset selection, right? If you do very basic stuff, get the mix roughly right, and do it for 20 to 30 to 40 years, you will have a fantastic result if you stick to your guns. But trading is really, really hard and complicated. Trading is, to be a really good trader, is at least an A level, and I would say probably to be a really, really good trader, a PhD's worth of work, right? Look at my bookshelf. It's not all trading books. There are quite a few trading books there. And even, trading also requires you to be very, very emotionally strong and psychologically strong. Like you could learn an awful lot about trading, but not be a particular, be a very risk averse person. And if you then get involved, you're likely to lose money, because you need to be able to sort of take risk on and live with risk and love risk. And one of the tragedies, which is largely to do with financial regulation and the rise of the crypto market, is so many people, particularly young people, that, I need to learn about finance. This explosion in social media, there's loads of stuff about finance, there's loads of blogs and blah, blah, blah. And they conflate trading with investing. They think they're the same thing, and they go straight to trading. I'm going to learn about finance. Now I've got this mate who's going to teach me about FX trading. I'm going to buy this crypto stuff. That is the worst possible rookie mistake, which millions of people have made in the last few years. And so what do you then do? Well, I don't know, 9 out of 10 people investing in crypto more than likely have blown themselves up. Because the other nefarious thing is, Bitcoin was £450 for a Bitcoin 10 years ago or 9 years ago, and now it's $60,000. Like, wow, that's amazing. But the journey from price X to price Y of any asset, it doesn't tell you the story about the thousands and thousands of people along the way lost money. Because particularly in anything volatile, because it went up here and then you thought, and then it fell and people panic and sell out. Now that's trading is trying to beat the market. I describe it as, so if you bypass all the conventional investment products and investing diligently every month, once you basically understand financial assets in a big picture way, to go to trading crypto, you are like a white belt fighting black belts. Because, if you've just woken up and said, I'm going to get into this finance thing, and what are shares? Well, I'm going to trade crypto, because there are all these Facebook groups and nefarious folk online selling you things, I can change your life. Give me £500, I'll change your life, teach you about crypto trading. And, you are a white belt fighting incredibly sophisticated black belts on day one, and therefore likely to get hurt. And what was the other point? I'll shut up now. Sorry, but there was another point I was going to make. I'm sure we'll come back to it.
Yeah, so the difference, so what we're saying is the difference between investing and trading. Investing is having an ISA account that we then put money into on a consistent basis into different types of assets.
Yeah,
And it's that money that's never sleeping, it's making money for us, and the magic money, which is compound interest, is giving us free money, and we can actually in the UK put £20,000 tax-free into an ISA. Trading is the stock exchange. It's the things that we would associate with the dot-com boom and equally the dot-com bust.
yeah,
And I think what I loved as well about your book, Andrew, is the examples that you gave were certainly for me very relatable. I mean, what sealed the deal for me is that you reference Sex in the
yeah.
City. And
Carrie's
I
shoe collection.
thought, I
Yeah,
love that this man knows what Sex and the City is. And I totally associated that because I was like, where's my money gone? I
yeah.
know I've had some.
I was such a big fan of all things kind of New York that I moved there, right? I lived and worked in New York for a while, and so unsurprising that I was a fan of that show back in the day. But yeah. So, I mean,
But
from
it's,
memory, she had, I think it was $30,000 worth of shoes and couldn't afford a deposit on a flat, and and
yeah.
lots of us do that in different ways, and
But
but
interestingly, her friends that all were, and actually this might be an interesting point to explore. So all of her friends, actually, Miranda, Samantha, and Charlotte, all owned their property. And in one of the episodes, Carrie was like, New York's a city of renters. And they all went, well, we don't. Now, something in your book, which playing a little bit of devil's advocate with you, you talked about this almost sort of obsession to get onto the property market in the UK and in the US, and that potentially it's better to rent. Now, whilst I understood what you were saying at a logical, rational, left-brained
yeah,
level, when I moved from Brighton to Edinburgh, and I've been here for 10 years. And within the first, it's about 4 years, I rented, and I had to move 3 times because the owner of the property either wanted to sell it or they wanted to move back in.
yeah,
So I had the pressure of finding somewhere that I actually wanted to live, and then the whole, packing your life up, the cost of removals companies,
a
and
lot
every
less.
time I
It's a
moved,
lot less than stamp duty.
uh,
My removals company for my last move was a hundredth of the stamp duty that I have to pay on the house I was moving into, or something like that, right? So, but if I may, look, I totally renting versus buying is a real hot potato, and let's be clear, I don't just say renting's better at all. I just say that most people do not do the sums and do not think deeply enough about what suits their circumstances and the merits of renting versus buying. And most people have assumptions born of conventional wisdom and the press, and renting's throwing money away and buying is always better, and you must get on the property ladder. There's no thought about the extent to which the property ladder can actually be the property snake, by the way, which happens from time to time. Property did nothing from 1900 till 1965 in Britain, and most people don't understand the difference between nominal and real. If a house, like the example I give in the book, let's say a house is worth £1 million in 2008, so that's worth $2 million because it was $2 to the pound. Let's say that £1 million house, well, let's just say it's still worth a million just to keep the maths easy. That house is now worth $1.27 million. So in the global reserve currency, you've lost $630,000 of real wealth, right? In the currency that everything trades in: cotton, coffee, oil, gas, gold, whatever. And my point is just that very few British people, when they contemplate the relative merits of renting versus buying, think in a sufficiently nuanced and advanced way. So I happen to rent at the moment from I mean, and by the way, I've endured everything you've just said. So I've had to move 3 times in the last 5 years, but each time I've moved into a fabulous house, and I'm paying my landlord a notional rental yield that means I could live in this house for 50 years and pay rent for 50 years before I've paid the same amount of money that I would have to pay to buy the house. Now, I appreciate I'm a fairly unusual, the sort of house I'm renting, I'm fairly unusual, but it's that for me is a personal choice just because I need my capital to invest in my own business and I'm an entrepreneur. So I'm very different to somebody who's on a conventional salary and on a very different path to me. So I don't think there's any right or wrong about renting versus buying. I think people just need to think far more deeply about it, and they need to realize that property doesn't always go up in real terms.
Mm.
Inflation has, if your property has gone up 10x, but a pint of beer has also gone up 10x, and the cost of eggs has also gone up 10x, and every other property in your street has gone up 10x. What that tells you is not that your property is worth 10x what it was worth before, is that inflation has reduced the value of money by 10x. And very, very few people understand that dynamic at work in the property market, right? So, sorry, there was another point I was going to make about it, but I'm sure I'll shut up again.
But I think I think what is important from what you said is, I think, I know for me personally, I got to a point where I just actually wanted to be able to paint my walls
Yeah,
a
well,
beautiful colour.
my wife's definitely been at that point ever since we met, and I've been renting the whole time, so she's deeply unimpressed with this
So
whole.
I really get that. But I think it's also, I think what you talked about, and maybe this is a good point to enter this conversation about more of the psychology, because I think there is certainly, for many, many years, when I lived in London and I worked in London in HR, there was this sense of almost shame that I wasn't on the property market, but I didn't actually value owning a property. I was far more interested in spending, and this is where my money's gone. It's not gone on shoes, it's gone on traveling the world.
Although I was going to say,
And
recently it looks like it's gone on Farrow and Ball paint for your property in Edinburgh.
that's not Farrow Ball. I won't say where it's from
Okay,
because
fine.
unless they're prepared to give me a lot of money in return.
Right, fair enough.
But I get a lot of questions about this color, actually. It's called Planet Earth.
Very nice.
But yeah, that's where what was important to me in my 20s is I wanted to see as much of the world as I could. So I took sabbaticals from work and I went traveling, and I don't regret that. But I think there was this sort of almost, and it was the pressure that I was putting on myself. It wasn't really coming
Yeah.
from anywhere else. It was thought driven, but it was this thought that I should have a property,
Yeah.
and the feeling of shame that I didn't own a property when everybody else in my network seemed to. So I actually really valued in many ways your views about the whole renting versus buying, because when I did make the decision to finally buy and get on the market, I thought, well, actually, you've not incurred a lot of the fees that other people will have. And even though some people might have bought their first property for £50,000, and I always had it in my head that, wow, they're going to be really rich. But actually, it's all relative, because to buy something now, they still need that equity.
That's right. That's the ultimate. The example I use in the book is if you buy a property, let's say in London, and it's 10x what it was 20 years ago. Crucially, you haven't increased your wealth in terms of houses in London at all, because every single other property on the street is also 10x. So it's completely nominal, eggshells game or whatever seashells, ball under the. That's a terrible analogy. Moving swiftly on, but if you want to move to rural Scotland where properties have only gone up 5x, you've doubled your money in terms of properties in rural Scotland. But in terms of a nice house on a street in London or apartment, you have not increased your wealth at all, because everything else has gone up the same amount. So that's one of the big fallacies about property. But to go to your point, that psycho-emotional point is really important, right? And this is the thing I rail against. Take a step back. What is property? It's a bloody roof over your head and a place to live. Sorry if I'm not allowed to swear, by the way. That was a fairly mild one. I'll moderate. But it is just look, people all over the world rent or live in mud huts, or life is to feel this latent pressure from society is very, very prevalent in Britain, and I think it's immensely unhealthy that you have to buy and you must get on the property ladder. I've seen people almost move to tears that they can't get on the property ladder in recent years, because if you're 25 and you've just moved to London or Manchester or any major city in the UK, property prices are at 300-year highs, right? And they are egregiously, and by the way, that's a huge failing of our political system, because, and let's pray that, assuming Labour get in today, one of the things they may do that may really help is to address this. But why has no political party addressed that prices are structurally very far too high, and punitively so, particularly for young people? Because it's electorally untenable, because all the people who've made that, to me, fake money, like, oh, I've made loads of money on my property. If you implement a policy of building 1 million new properties out and about in the UK to ameliorate that and freeing up the planning regulations, all of those house prices are going to fall by 30 or 40 or 50%, and you've lost your electorate, because young people are very bad at voting, old people are very good at voting. So no political party has found it politically tenable to address house prices going up far too much, and terrible policy around interest rates for 30+ years, because it's just not electorally tenable. Because if you're the party in power when house prices crater, you're not going to be in power in the next electoral cycle. Now, it'd be very interesting to see what Keir Starmer and Rachel Reeves are able to do under the cover of being nice, warm and cuddly Labour and having a massive supermajority, because they might actually be able to address this, which I think is enormously bearish for British property. And the other point, so a couple of points I wanted to make is, first is, if you are a young person and you can't get on the property ladder, don't stress about it. Just rent. Just get the best possible out. Property should be, and I know this for somebody who's just moved to London and is starting on a graduate salary in London, this will sound insane, but property shouldn't really cost you more than a third of your income, right? Whether that's mortgage or rent, and capital repayment mortgage or rent. We now live in a world, because of crazy interest rate policy, because of this kind of this malaise. People, I've got to get on the property ladder. People have made, based on a 200-year view of the property market, right? A lot of people have made poor decisions and bought property when interest rates are 1%, expecting interest rates to always be at 1%, when the long run average of interest rates in the last 50 years has been 6 or 7%. To me, it's like, we shouldn't allow anyone to take out a mortgage unless they are familiar with the 50-year chart of interest rates. Because that's what we've got all these people, we've got good middle class educated people who had a mortgage that was £2,000 a month, and it's now £6,000 a month. And by the way, it might end up at £8,000 a month, and they're in all sorts of trouble now. So young people, anybody listening to this, sort of millennials or lower, just rent. Just find I rent. By the way, my first 3 or 4 rental properties when I first started in the city were awful. And I lived in Borough. I didn't live in Notting Hill. There were gunshots on a Saturday night, and the only good thing about living in Borough was I could walk to the Ministry of Sound, which I quite liked doing at that my early 20s. Right? But there were literally gunshots.
That's where we met before. When you said
on the podium, exactly in 1995 or whatever. But this is really important. It really makes me sad to see children of my friends or family members just obsessing about the property ladder, and cause themselves real emotional distress. So that's one thing I'll say. And the other thing that they'll say is, here's a really, really important stat, notwithstanding what I just said about Labour, the potential change we finally might be able to make with greenfield development. They've already said publicly they want to build 1 million new housing units, right? Which we're crying out for. And the other thing that's nothing to do with the government and is just an inexorable reality of demographics is, 20 years ago, in the last what's it called, census? Yeah. The census.
Yeah.
The number of people over the age of 90 in Britain was about 150,000. In the most recent one, it's 650,000. Right.
Oh.
Nonagenarians, people over the age of 90, are sellers of property. Because without wanting to put too fine a point on it or be vulgar, because they die, right? And basically, particularly now with inheritance tax rules and everything else, if a sort of good middle class person in Britain somewhere dies at the age of 96 or whatever, 9 times out of 10, they are a seller of that property. because their adult children even can't afford, if you've got three children and it's a 1.5 million or a £2 million property, it's quite rare that one of the siblings can buy the other two out. And 9 times out of 10, they're just going to want to put it on the market, take the money, and split it between the three of them, right? And there is going to be, so there's a huge demographic bulge of people over the age of 90 in the UK. There's a similarly large demographic bulge of people over the age of 80 in the UK, and life expectancy in the UK is 84 or 85 or whatever it is, men and women roughly the same. And that to me means there's going to be an absolute flood of housing coming on for sale in the next few years, right? Now, so when that happens, how many people in their 40s or 50s or whatever are going to be economically empowered to buy a £3 million house, or like 30 times the income of somebody who's on £100,000 a year, right? And I concede it's anecdotal rather than empirical, but I'm on Rightmove's alerts for properties for 14 counties in the UK, and I've been astonished. Just every week now, I get a weekly property alert of all properties in Surrey, Hampshire, Essex, Cambridge, Yorkshire, Devon, Cornwall, blah blah blah, north of £2 million. Am I allowed to say the phrase property porn on this? I mean, it's just it's food porn, property porn. I just like looking at beautiful houses. It's an aspirational thing to do, and seeing what's around and what the market's doing. As a student of financial markets as well. And I can tell you, as I say, anecdotal. A year ago, there might have been 3 properties in Cornwall in a week for sale, or none, or in Devon, or in Cambridge, or in wherever, or in Bath. Now, regularly, those alerts are like 12 or 15 or whatever, right? So it's already happening. And interest rate policy is really important, etc. But if you just want to talk about the British housing market, there are going to be millions of sellers of often, especially in the southeast of England, large family homes, and very few million people, I think, who can afford to buy those homes without a big move in the price. So, if you're young and you're worried about getting on the property ladder, I really wouldn't. I'd just get the best possible flat you can get. Try not to spend more than sort of 33-40% of your monthly income on that. Even if, I lived in a terrible little 1-bedroom flat and I was working for an investment bank in the city. Don't play the keeping up with the Joneses game, because it means that today I live in a beautiful large family home because of those decisions, right? So anyway, wow, I'll get back off so we went down.
No. So one question before we actually talk about the sort of psychology side of things. So we've talked about, or you've talked about, the analogy that you use in your book is the hare and the tortoise, that investment is a long-term strategy. It's not about becoming a millionaire overnight. And I suppose one of the things that I experienced when I read your book was like, oh, well, I'm kind of mid-40s and a lot of my friends are in that same age bracket. So we don't have a lifetime of investment opportunity compared to, my nephews, for example, who do have ISAs, who've probably got more money in their ISAs than I've got. So what would be the advice for people that are sort of listening to this, and it's the first time that they're understanding and hearing this information, but they're in their 40s or even early 50s and think, oh, but is there any point, because I don't have the same time scales?
Well, the answer, that's not a difficult question to answer to somebody in their 40s. It is a difficult question to answer to somebody in their 70s, which happens to me a lot. I'll get somebody saying, I love your book, I'm 74 years old, I've got... The average British person has £50,000 in their pension at retirement, and what they need is £500,000, preferably £800,000, right? And this is why I'm very mission driven, because that's scandalous. And also, given that the government, it doesn't matter whether it's Labour or the Tories, we have a demographic situation where future governments are not going to be able to fund people who want to retire at 60 and live to 100, right? Which is what's going to happen biologically because of the improvement in healthcare. And this is why the NHS is in so much trouble. It's just all the stuff I was saying about the number of 90-year-olds and 80-year-olds. You could throw £500 billion at the NHS in the next few decades, and it's not going to make a jot of difference to the waiting lists, no matter whether you're Labour or Tory, because there are millions of elderly, infirm people who need billions of healthcare in a way that we didn't 40 years ago, because there weren't, right? And there are far fewer people paying tax. But to answer your question, come back to the specifics of what you're asking about is, you said it's not about becoming a millionaire overnight. That's right. But it is about becoming a millionaire over 20 to 40 years. And if you start in your 20s, so I always say basically 25 to 65, optimally, let's say, if you're really good and you work in a bar at university, or, I was a choral scholar at university and I made quite a lot of money actually from doing weddings and funerals and being paid a term to sing in a church every Sunday morning, which was amusing, coming out of nightclubs and going straight to do Mozart. And then getting funny looks from the other members of the choir who are 30 or 40 years older than me. Anyway, 20 to 60 or 25 to 65, let's say, 40 years gives you an amazing chance of becoming a millionaire. Even if you're on an average British income wage, because if you start that long, compound market returns, you've got a really good chance of being a millionaire. Now, let's say 45 to 65, though, you've missed out on all that opportunity in the compound and everything else from the last 20 years, but your advantage is you're a higher earner, or you're very likely to be a higher earner, right? So I always talk about 20-somethings, get £25 a month to work. That's the minimum that you can invest with a lot of the big investment platforms in the UK. Do it. It's absolutely worth it. To go to my example about £1,000 television being £63,000 in your pension 40 years later, right? You'd be amazed. £25 a month, every month for the whole of your 20s. And of course, that's when you're working in a bar and you're struggling to make ends meet, and London's so expensive and you're spending a lot on rent and going out and blah, blah, blah. But let's say by your late 20s, you've got a slightly better job. You've now got a proper job. You've had your first promotion. I've worked in lots of bars in my life, and even as a sort of ridiculous cocktail barman, but I wouldn't have described that as a proper job as a cocktail barman. But let's say you can up that to £50 a month, and then because one of the most important things here, it's like you're an expert on all things psychology, right? Habit. James Clear, that brilliant book, Atomic Habits. If you start saving 25 quid a month by direct debit in your 20s, the probability that by the time you're 35, you're saving £300 a month because you've been doing it your whole life, you've seen that, is high. And the probability then when you're a company director, when you're 56 and you're saving £800 a month is very high. If you never ever start on that trajectory and don't do it at all, it hugely reduces, that's the case for tens of millions of British adults, tragically for us, for them and for society. But if you're in your 40s and you're having this Damascene conversion and finally coming across all that stuff, that's fine, because it's not fine, but if you're a high earner, you can hopefully save a few £100 a month rather than £25 a month, or at least many people can. I know not everyone can. But and the other thing I would say, we weren't going to talk about this, but my new book's about the biotech industry and how it's going to revolutionise lots of things. Healthcare, environmental degradation, power generation, way more than people realise. I've been looking at biotech for the last decade, and it's very exciting. There's this idea that health span is going to increase. So, 60 today is the new 40. If you read the lifestyle magazines,
my mum will be very happy to hear that.
but if you look at a 60-year-old, even as recently as the 1960s, they were really old. Even my grandmother, who was a healthy woman who did yoga until the day she died, when she was 60-something, I remember her as looking like a granny. She really looked very old. Whereas a lot of bless you, Grandma. But today, there are 60-year-olds who functionally don't really look that different to 45-year-old, right? And that they've kept themselves in shape, they've eaten well, they've read a few books on longevity. That is because of improved nutrition and blah, 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 blah. And I acknowledge you have to be quite wealthy. The wealthier you are, the easier it is to do this, because you can afford the nutrition and the supplementation and the gym memberships and the skin treatments and everything else. But it's certainly something to aspire to do the best possible job with. And my point there is that if you're a white collar worker, if you're a coal miner, it's different, I acknowledge. But if you're a white collar worker, and most people in Britain are, this is a knowledge economy, there's every chance that if you're 45 today, you've got another 50 years ahead of you where you could work. Now, you don't necessarily have to carry on working a horrendous grinding, 9 till 5 or 7 till 7 or whatever, so many people doing working weekends and like you do at the peak of your career in your 40s or 50s. But, one of my board directors is in his very late 70s and he's fantastic. And I'm delighted he's one of my board directors. And he has a portfolio of things he's still doing at his option. He does whatever he wants to do. So it's both. You need 20 years. If you have 20 years, you need to be investing more than £25 a month. Every year above that you have is good, and aspire to increase your health span so that you're fit, healthy, and I mean there are lots of serious academics and clinicians now saying that it is not unrealistic to expect that anybody who's roughly 50 years old or younger today will be able to be functionally as young as 50 into their 80s because of what's happening technologically. And so, hopefully that's a relatively positive message to set against the horrendous tragedy we have with our pension system in this country, which is also true.
Absolutely. No, that makes a lot of sense. So coming more into the, I really hear what you say, that there's been a lack of this financial education. So people are, and I would have included myself in this, financially illiterate. And yet there is also, the one thing that we are governed by as human beings more than anything else is fear.
Yeah.
And so I find it fascinating as also a coach and a therapist to dive into the human psyche, the personal mind, and sort of step into somebody's map of the world. Yeah. And understand, I remember growing up as a child, my dad had a desk and he had tobacco tins. Not that he smoked, but he just had those old-fashioned tobacco tins, and there was 20 quid for the electric and there was 10 quid for the gas. And it was great when I was 18, because if I ever needed some money, I knew exactly where to get my hands on it. But I think about my dad, he actually does invest. He worked for GlaxoSmithKline for many years, so he has shares in them, and he's dabbled here and there. And yet he would absolutely consider himself more risk averse, which is everything about his mindset. And so for people that are, as you say, they're skeptical or they're fearful, apart from coming to work with somebody like me, what's the easiest way for them to change their relationship with money?
Well, so I was very honoured in 2016 to be invited to contribute a chapter to a book called Harriman's New Book of Investment Rules, which actually, if I just quickly, that's it there. So you can't see my finger pointing, but it's to see where the light is. It's the orange one. Anyway, let's get back over here. Okay. And the reason I mention that is because I wrote a chapter. It was a bit like, I explained to my mum at the time, it was a bit like as if I'd produced a pop song. I'd been asked to produce a pop song for a compilation and album, and then found out subsequently, whilst in the process of producing the song, that the other people on the album were going to be the Eagles, Coldplay, the Beatles, the Rolling Stones. So it's basically a who's who of the most amazing investors. I was so honoured to be in that, and one of the chapters. But my chapter was called How to Invest So That Crashes Don't Matter. And that's a big theme of ours, and I'm replicating it in the new version of my new book, which is like, there are a number of approaches to investment that mean you don't, risk aversion, loss aversion is a very, very fundamental psychological cognitive bias, right? Do you know the surgery example about loss aversion? It's amazing. It's the so if somebody sits in front of a surgeon and they have to have a life-saving but dangerous surgical procedure, like removing a brain tumor or something, this is well referenced by kind of leading, Ivy League psychologists. It's in the literature, but if the clinician sits across from the patient and says, you're going to have an operation, it's a very risky operation, we could lose you, but you have a 90% chance of survival, the percentage chance the person decides to go ahead with that operation is way, way, way higher than if the clinician says, I have to warn you that this surgical procedure has a 10% chance of death. It's statistically the same, 90% chance of survival, 10% chance of death. But if you present it to the person as 90% chance of survival, they go, yeah, sure, let's go ahead. Don't need to get the brain tumor out. If you tell them they've got 10% chance of dying, they say, no way, don't do that, right? So, and it's the same in financial markets. And the way to the way to get around that innate, that very robust innate human psychological cognitive bias is information, is knowledge, right? And you can, so the broad ways of doing it we talked about, at the top of the call are, firstly, if you know what you're doing, if what you're doing is evidence based, once you've got comfortable, I understand what the stock market is, I understand what a bond is, I understand what gold is, and what I understand inflation and interest rates, which, as I said earlier, is no harder than learning how to drive a car. It's one book. It doesn't have to be my book, but that hopefully is a helpful one. But it's one book. It's a few rainy Sunday afternoons to get comfortable. Once you're equipped with that level of knowledge, then you know what to do. You just invest every month. You invest for very long periods of time. You ignore the news. You ignore financial market crashes. You have the right mix of assets, of lower risk assets and higher risk assets, based broadly on your age and stage. Because if a 30-year-old has £10,000 and they lose 50%, all their money is in the stock market and it falls 50%, like it did in 1999, 2000, 07, 08. £10,000 becomes £5,000. That's pretty annoying and stressful. And it's after all those bar shifts you've done to get your £10,000 saved, you're pretty pissed off. That's a very, very different outcome, in real world outcome, to a 60-year-old who's been a top lawyer and spent 30 years building to £1 million, who goes from £1 million to £500,000 in the same percentage fall. So that's why it's really important to get your mix of higher risk and lower risk investments based roughly on your age. But once you know all this stuff, you can be risk averse. You can be averse to loss. You can be prudent. You can be conservative, and you can still capture investing upside and sleep at night. That's the whole point. It's just a little bit of knowledge, like everything else in life, right? Sorry, that was another 10-minute answer, but hopefully it's helpful.
The last area then is, so as you know, our organisation, the Mind Solution, we work with organisations across the globe, and we do huge amounts around employee wellbeing. And I see financial well-being as being a key pillar in overall well-being. And I think absolutely financial well-being is also being able to manage that mindset in a way that works and creates empowerment rather than creates fear.
Yeah.
But from your observations, where do you think organisations can be doing far more than they're currently doing? Because there are some organisations that do a lot around pay and reward. They've got the occupational pension scheme. They might have some great pay and reward benefits, but what I don't see a huge amount of is financial well-being training, the kind of conversations that we're having right here and right now. So I'd love your thoughts around that.
Well, yeah, if I knew the answer, I would have sold, 500,000 more books than I have sold, right? Because hopefully every HR department in the country would put a copy of, or give all of their staff a copy of my book. Or, it's hard to know what the answer is, because to me it is such a missing link, right? This is a panacea. This is a silver bullet. I think partly because of the British class system, we are, we don't talk about money, and people don't want to know, oh, I'm not interested in the stock market. I don't want to know about that. That's boring. Pensions are boring. If you Google boring pensions, you get X 100 million results in a nanosecond. And it's this crazy societal blind spot, because it is above everything else, the right relationship. As soon as you understand all the stuff I've talked about in the last few minutes about investing for the long run and what the stock market is, and the basic nuts and bolts of all this stuff, life becomes so much easier and less stressful. Because the minute you can say, right, okay, I'm going to, budgeting is important. That's a sort of, GCSE level kind of thing. Get your budget right. How much do I earn? How much do I spend? Right, get that square. That's great. But then with the surplus that you free up, which you must free up and you need to free up, you don't want to be really poor for 40 years of your life. That's the other point is, it's an inexorable, inevitable mathematical fact that anybody who doesn't sort out their own private arrangements for retirement is going to be really poor in this country, because we're not creating enough wealth. And why have we got a cost of living crisis? Because to combat the fact that we're not creating enough wealth, the government has invented £400 billion of wealth out of thin air. And if this is what people don't understand, if you think about the supply of stuff as one, agricultural products, wheat, pasta, coffee, cotton, toilet paper, just stuff, or petrol, fuel car. If the amount of stuff in the world is one, and the amount of money in the world is one, the price of the stuff is one. If you increase the amount of money in the world to two, that doesn't actually cause farmers to, well, there's a time lag, but basically there's no more stuff. You can't double the amount of stuff because that requires crops to be planted and new mines to be found and new oil rigs to be billions of pounds spent on. So if you increase the amount of money from one to two, but the supply of stuff is basically fixed, which is basically the case for less than, say, a decade, because to really increase the real wealth of the world, you need years of building oil rigs and whatever else. What happens? The price of the stuff doubles because you've got twice as much money chasing the same amount. And that's basically what Western governments have been doing. It's a dog and pony trick. It's a smoke and mirrors thing, because rather than stand up and be honest and say, we've made a real hash of things for 50 years and spent more than we can afford, and done that
asking the government to be honest. Come on.
Well, we used to manage it. The Victorians managed it, and I mean, don't get me wrong. I've read not Charles Darwin. Who wrote Nicholas Nickleby? Charles Dickens. I'm aware of how awful it was to be a child in a Victorian factory and everything else, but the explosion in real wealth from sort of 1800 to 1900 and forward progress for mankind is unbelievable. And we carried on doing that because they were basically deflationary and they had sound money. And sadly, I'm now going right down an intellectual rabbit hole. I'll shut up. But so sorry, where was I going?
Organisations. What can organisations be doing to their people?
Obviously, give everyone a copy of my book.
Obviously.
The other thing, though, in all seriousness, have you come across a book called The Psychology of Money?
It is on my bookshelf.
Yeah. So Morgan Housel, that's the book that I wish I'd written, but it's also written for it's written for a global audience. My book, one of the commercial challenges of my book is it's written for a British audience, which means that nobody in America wants to buy a book that tells them what an ISA is, right? So that's my cross to bear. But whereas his book's just much more big picture stuff about the psychology of money and how that relates to how you conduct yourself and how to be happy, if you like. So,
although to be fair to you, The Psychology of Money is on my bookshelf and has been on my bookshelf for months and months and months. I actually read your book.
That's great. Well, I would encourage you to join the 5.5 million people, annoyingly, who've read Morgan Housel's excellent book, The Psychology of Money, because it's really nuts and bolts. But how do you? I mean, a good start would be the HR professionals at large corporates know this stuff, because actually, in my experience, very few of them do. And as I said before, even in top investment banks, like it's crazy. The number of titans of trading floors. It's not as bad now as it was when I started my career, but it used to blow me away that. And just to take a step back, I did a degree in economics, and I got a good degree in economics from a good university, and I started my career in the city. And nothing I did in my economics degree in any way equipped me to know about any of what we're talking about, or maybe 2% of what I'm talking about. Like, a degree in economics doesn't really give you any grasp of ISAs or pensions or long run investment. It's all this theoretical nonsense about demand and supply curves, and most of which has no real world application at all. Hence why the economics profession has been found so lacking in the last 30 years through the global financial crisis and everything else. Economic history, that bookshelf had taught me way more than my degree, right? History and economic history, but and I guess that's the point, is it's that small amount of information about the nuts and bolts of the information that's less than learning how to drive a car. We need to get that into HR professionals at large organizations, and then hopefully that percolates out into their staff. And it is getting better. It is getting only a little bit, but it is getting better.
And I think my approach would be, because I think there's, working with so many HR professionals, and my background is HR, is that even the whole spectrum of what is employee well-being, so many HR professionals, for example, they work with our organisation because they recognise, we're not specialists in well-being, we're not specialists in financial well-being, mental health,
Neurodivergence.
neurodiversity, all of that kind of thing. So, I mean, I think the HR and organizations have come on a huge amount since I worked in HR 12 years ago, but where employee well-being pretty much was
A nice to have.
well, it was a company, you still had your company pension scheme, you maybe had some subsidized gym membership.
Critical
Can't
illness
say
cover.
free fruit. I don't think actually the best well-being is when I worked as the head of HR for British Airways Holidays and Virgin Atlantic. My free flight concessions. I was a very happy
Very
young
good
woman
indeed.
there. But I think and I think it's interesting because, as I said to you before we hit record, you know, having had several financial advisors, of which neither of them have given me any insight compared to your book, that I can imagine that a lot of a lot of HR managers and leaders might think, well, we need to arrange well-being training. Let's get in a local financial advisor. But actually, my response, having read your book, is, oh, actually, I don't know if that is the right approach because mine have not really done anything for me personally.
But, I mean, any profession has good and bad participants, right? Well, even hopefully not airline pilots. Hopefully they all get past a certain level of being able to
Or
drop.
surgeons, you'd
Or
kind of
surgeons,
want
exactly. But
the
there are terrible GPs. There are obviously lots of very intelligent GPs who keep up with the latest research, and there are plenty of lazy GPs who don't do a particularly good job. And I'm not, sorry, that's a bad example, but in every lawyers, whatever you want to say.
I get it.
But one thing to say about financial advisors, which I say in the book, is so to become a surgeon takes, let's say, 10 years conservatively, right, before you're actually let out a patient. To become an airline pilot, you really have to fly the plane, and that takes many, many years. To become a rocket scientist, you have to get a PhD in, astrophysics or fluidics or whatever it is that you need to build rockets. To become a financial advisor, you can get qualified in about 3 months, right?
Wow.
If you're relatively smart at passing exams, and if you're particularly if you're what used to be called a tied advisor, so you're just working for a big company selling their products, rather than a whole of market financial advisor who's somebody who can sell you everything that's available in the market, which is always you should never go, in my view, you should never go to a tied advisor because it's like you're just running on rails. Only able to do half a dozen products from that whichever company that is. And that's been getting gradually better, and I cover all that stuff in detail in the book. There's a whole section at the beginning of six reasons why you can do better than financial professionals. And they're fairly intractable structural reasons, and that's been a part of the problem, is that we allowed this thing to grow up, and a lot of the industry participants in the financial advice space weren't very good, didn't need that much, didn't know much more than the average person's stream. I told you again before we hit record, when I was about 25, and I'd had my first fairly well-paid year in a city career, I went to see a financial advisor at my bank, which was a high street bank. And I won't name which brand it was, but I imagine the experience would have been the same at all of them, and probably still is to this day. And the financial advisor that I was put in a room with was very young, quite nervous actually, probably quite rightly given what then happened. Knowing that I was a city professional, and that person didn't know that there were ISA products available other than the ones that high street bank sold, which is literally like going to let's say you want to buy a bottle of wine, and there's a shop that only sells a really crap wine from a terrible vineyard in China, and then you say, so well, what about some Bordeaux or some Burgundy or some Argentinian Malbec or some? And they're like, well, what's that? That's literally the analogy, and so you've got a significant chunk of the financial advice community where there is a problem, a structural problem, right? And to be very clear, there's also a significant chunk of the financial advice community that are really, really good and really diligent and really care and get a great result for their clients. But for most They are very expensive. I did a video on our YouTube channel a few months ago, called something like "The Problem with Financial Advice," and it's this. The press call it the financial advice gap, which is that financial advice costs thousands of pounds basically once you factor in all the costs and the carry on your money over a lifetime of using a financial advisor. Most people can't afford it, and so most people don't get financial advice. And even people spending a lot of money on financial advice, to your example, can still get fairly bad financial advice. So, like everything else in life, most of us don't use a driver. Most of us learn how to drive a car. Don't go and become a DIY investor, because, like I said, it is work. You need to read at least one book, and as I say, not just mine, preferably 3 or 4. But it's a I wouldn't say it's any more than tens of hours of work, and to have a life-changing effect on your life and on your loved ones. And although the final thing I do want to say about this is very important. Everything I talk about takes 20 years. Because what happens at least 20 years, right? A lot of people get started, oh, I've started investing, and then they get in touch with me 3 months later and go, oh, I've invested.
I'm not a millionaire yet.
I mean, true story. People going, I've invested £200 a month for the last 3 months, and I've got £565 in my account. You said it was impossible to lose money. I've lost, the equivalent of a takeaway. Or it's like, oh my God, you just have not understood at all everything I've written, 200,000 words about in the last 10 years. Please go away and, do it again, try harder, and come back to me. So it's really important. This is something you do. It's a life habit you develop, like going to the gym or walking or run or whatever, that you do for many, many, many years in order to get this result. And if you do it for many, many years, you will very, very likely get this result. And that result is life-changing. And by the way, sorry, without wanting to get party political on today, the general election day, I wince slightly making this point, but I genuinely believe this. The reason there is inequality, largely, in the old days, it was because aristocrats were violent people who did a better job at killing other people. It always makes me laugh, like Lord so-and-so, Duke so-and-so. It's like, yeah, well, your ancestor was better at killing people for the king than the other people, and that's why they've got a massive estate and own half of Hampshire. Like, it just seems like a fairly nefarious way of choosing our elites, right? Violence. That was what it was. Whereas today, we're in a much more meritocratic world, and the wealthiest people, so if you compound at, let's say, 10% a year over 40 years, so somebody who doesn't compound at 10% a year for 40 years isn't going to be like half as wealthy as the person who does. They're going to be £1 million less wealthy than the person. And if you apply compounding not just to financial, investment accounts and investing, but to everything else in life, the gym, diet, nutrition, everything else, the difference between somebody who compounds their life skills and their finances over a whole lifetime and somebody who doesn't, if you do 10 press-ups a day from the age of 20 to 60, you'll have done like 150,000 more press-ups than the person who does none. You can't really tell the difference between some, at 25, but at 60, that's front and center why one of them's on an NHS waiting list and the other is a sprightly 60-year-old who's still climbing mountains and, playing tennis. I mean, like, I'm a huge believer in this stuff, little and often, incremental, and the power of compounding in finance and also in life. And it's why, the richest 1% of the people in the world, apart from in places like Kazakhstan and Russia, where it's still all about violence. Sorry, I shouldn't say that about Kazakhstan. I can definitely say that about Russia. In the more meritocratic West, people who learn about capital markets and take steps to use capital markets effectively are far more likely to become wealthy than people who don't. And they will become very, very disproportionately wealthy, particularly if that happens over several generations. If my grandfather's somebody who invested in the stock market in Belfast in the 1950s, I don't think he did actually, but he was fairly prudent. And then my father's somebody who invested in the stock market in the 70s, and then and that money is kept, notwithstanding inheritance tax. That's why the Rothschilds have been compounding returns since 1800. I mean, that's why that front and center is why they're disproportionately wealthy, not because they're nefarious lizard people, who are pulling the strings behind all the government. It's just nonsense. But anyway, a controversial opinion, but one I think is very evidence-based.
Well, I think as a close for anybody that's listening or for organizations that are listening to this, I feel that this is such, along with, helping to educate people about the way that their mind works, which I see as equally important, little and often, navigating the inner landscape of our minds. But certainly for anybody that's listening, I don't recommend books very often. I get a lot of people saying, please can we come on your podcast and promote our book? And I'm like, no. But I do genuinely recommend Andrew's book as a very plain English guide to taking the steps, particularly if you are a UK resident. And I don't think it's a ridiculous example to give employees a copy of your book to achieve that kind of level of financial understanding. So thank you, everybody that has listened. I know that we've covered a huge variety of
sorry for like, I've got this terrible tendency of having a couple of strong espressos before I do a podcast, which I've probably got to stop doing because then I just like shout at the screen and get off down.
Well, you're just very passionate, and I feel exactly the same when I'm talking about the human psyche and the mind and the body and how do we take action from that, because it's a bit like, in a sort of slightly different example, but somebody that learns about mindset and how to make their mindset work for them is going to be in a very different position compared to somebody that never takes an active interest in understanding the human psyche. So it's kind of one of the same, but just a slightly different topics.
Well, the sort of four pillars of financial literacy, nutritional literacy, exercise literacy, and mindset literacy. If you get those four things roughly right, you're going to have a great life. Life is going to be much better. And I think most people miss, maybe they're really good at what they eat and they're good at exercising, but they don't know about finance and they don't know about mindset. Most people haven't got all four of those pillars in place.
Yeah.
And I think the finance one is probably the least well understood, and there's an awful lot out there about the other three, but perhaps a little bit less about finance. So anyway, that's just my view.
No, and I agree with you, and that's why I wanted to jump onto this call today, because I think for organizations I see so much being now done. I think there was a big focus on physical well-being. And now we're seeing more coming in the mindset, mental health area. I still think there's a huge gap around emotions and regulating people's emotions, which we're fully equipped to help people understand that. And I agree with the financial. So I hope that this interview has inspired people. I hope that you are going to take action. Andrew, if you want to stay on the call for a moment, I'd love to hear any comments, any thoughts that people have. Just leave them in the comments box or drop us a line at info@themindsolution.com.
And may I say, just before you, before you stop, for what it's worth, I'm delighted to come and speak to organizations about finance. Like, it's something I do more or less regularly. So if any of your audience, perhaps we could go in, fight back to back and present on finance and your core, what you normally do, then that's something I'm certainly able to consider, as long as it's kind of far enough in advance in terms of diary commitments. So I hope you don't mind me saying that.
No, not at all. And actually, this is a conversation that I was going to have with you anyway. So,
oh, fantastic!
I will stop. We're going to hit stop because we'll be here for another 2 hours otherwise. But if you want to stay on the line, Andrew, and thank you everybody for listening. And please do feel free to either subscribe and share this on social media. But have a wonderful, wonderful day. Bye bye for now.